Hello, good morning and good afternoon, everyone, wherever you are listening to us from. Welcome to our latest European Structured Finance webinar. In these webinars, we pick one topic related to European securitization market and update our listeners on the DBRS Morningstar credit views and findings. This week, we are discussing the Dutch housing shortage and the growing buy-to-let market. My name is Untitled Chapter, and I head up the European Structured Finance research efforts at DBRS Morningstar here in London. And today I'm joined by Simon Murphy, who is a vice president on the analytical side in a European operational risk team at DBRS Morningstar. We will be giving you a presentation. Followed by the presentation will be an opportunity to ask us any questions. Or we will answer any asked questions at the end of the presentation. You can ask us questions by writing into your online portals where you dialed in from. And you can also ask us the questions during the presentation while we're presenting, but we will answer them towards the end of it. So without further ado, we will briefly walk the audience through the European housing market before we delve into the details of Dutch housing market, what factors are creating a shortage in housing supply, why now and in the past couple of years Dutch buy-to-let market has risen in prominence, what are the certain government initiatives to curb the rise of buy-to-let market and make housing more affordable, both from a rental purposes as well as purchasing side. And then we will give you a brief overview of DBRS Morningstar's methodology for rating Dutch buy-to-let RMBS transactions. So on this slide, you will see year-on-year changes in prices in major economies in Europe. Since the beginning of the pandemic, contrary to most predictions of that time, house prices continue to rise. And while major economies experienced mass shutdowns, unemployment increased, and most European economies offered holiday payments to some small segment of the mortgage market. To prevent collapse in the housing market, further tax breaks were offered, i.e. 0% tax transfer taxes or reduced stamp duty for the first-time buyers. Combined with these helping factors, along with low interest rate, accelerated the house prices as shown in the chart here. Housing became even more important, especially in the suburbs and the commuter belt towns, where open green and large living spaces were desired. Across Europe, property values have risen, and some places a double-digit growth has been noted. It's more obvious in Netherlands, as from the chart. The year-on-year increase till the end of Q2 of 2021 has been around 13%, followed by UK, which posted a annual growth of 10%. General fiscal and monetary interventions may have masked some underlying chronic supply issues in the housing market, and that further propelled the property prices higher. A trend more evident in Netherlands than any other major economy in Europe. Though there are several there's some clouds on the horizon with regards to these elevated prices, and as the support measures of various governments are retracted, and growing worries of rising inflation is becoming a bit of a headache for central banks, and as central banks try to put a handle on inflation, it is anticipated that there would be an increase in interest rates. And with increased interest rates, it will hit the borrowers and the consumers duly, because inflation will erode the purchasing power in the wallet, as well as increase the burden of servicing their debt on a timely basis. We still believe that these factors, especially in Netherlands, though maybe elevated, but not necessarily will impact the housing prices negatively in the near future. And with that, I'll make way for Simon to walk us through some of these factors and give us a little bit more context to some of the issues which Netherlands government has dealt with. Over to you, Simon.
Thanks, Madassa. Okay, so I'm going to start off by talking about the shortage in the Dutch housing supply. So according to the State of the Housing Market report that was presented to the Dutch Parliament in 2020, there would need to be 845,000 homes to be built by 2030 in order for the Netherlands to have enough housing for its growing population. So the country currently has a shortage of 331,000 homes, but the government is assessing measures to accelerate supply to meet this demand. But the shortage is expected to persist for the next 30 years as well. So in essence, the construction of new build homes has not been keeping pace with the number of homes required. So we can see from in the Netherlands, you need to a permit in order to build a property, and we can see that from this graph here that the number of building permits issued has been increasing since late 2020, but those level of permits is still roughly similar to what they were in 2017 and 2018. Now, as you can see from the graph, the most recent quarters of data available there, the number of permits that were issued were just below 20,000 per quarter. Now, there have been calls to increase the number of new builds to 100,000 per year in order to meet demand. So that would need to increase to 25,000 permits per quarter. Now, you can see that the level of permits, they actually dropped the most in 2019. Now, the main reason for this drop in 2019 was the nitrogen crisis. And that's because the Dutch Supreme Court abolished the nitrogen approach program in 2019. Now, the program was abolished as it was found to be non-compliant with EU regulations surrounding nitrogen emissions. Now, the reason why that they said it didn't comply was that the program was designed in such a way that new build projects would compensate for any nitrogen emissions that were caused by construction work at a later date, and not dealing with the issue as it was going along. So the Dutch Supreme Court found that program to be in breach of regulations, and they ruled that any nitrogen emissions must be reduced before new projects could start. So that brought many construction projects to a halt throughout 2019 and 2020. However, there were protests from both the construction industry and farmers, because farming is also a large contributor to nitrogen emissions. And those regulations were actually rescinded in December 2020, and construction projects were allowed to resume, which is why you've seen the increase in the number of permits issued from late 2020 there. And the reason they were able to rescind those regulations is the Dutch government took several other steps in order to tackle the nitrogen emissions. And they did things like reducing motorway speed limits, so there were less emissions there. But as you can also see from the graph, there have been 6 consecutive quarters of increase with the number of permits issued compared with the same period in the previous year. So that's kind of the reason, some of the reasons behind the shortage. Now, moving on to the growing Dutch buy-to-let mortgage market. So the housing shortage has caused property prices in the Netherlands to increase sharply. There's an average purchase price of €402,000 in the Netherlands, which is €153,000 above the average purchase price of 5 years ago. And the lack of housing has actually driven many buyers to bid above the asking price to secure a property. So in the Netherlands, there's a consistently stringent underwriting standard, and this is applied across all lenders. So this standard, combined with the high property prices, have made it increasingly difficult for people to buy properties, in particular first-time buyers. As you can see from the graph on this page, the price to rent and income ratios are rising, and that could be a sign that renting might be preferred for many would-be buyers as their affordability measures continue to face pressure. As you can see from the graph as well, both price to rent and price to income ratios are quite high, but they're under their previous peaks of 2007. So this could signal that the market is heating up. But in our view, an imminent house price correction is not expected, but investors should possibly be wary there. So moving on from that slide, we can see that there's a structural demand for rental properties that has been driven by the increased property prices and the stringent underwriting criteria. Now, this increased demand for rental properties has led to greater demand for buy-to-let mortgages in the private rental sector. Now, after the financial crash, it was hard to get a buy-to-let mortgage in the Netherlands. It wasn't a commonly available product, and if an investor or a landlord wanted to get a mortgage, they would need to approach the bank and ask for that specific mortgage. However, in 2015, these kind of mortgages were reintroduced into the Netherlands, more commonly by NIBC. And the buy-to-let market is now currently estimated to be worth around 200 billion euros. So obviously, investors have sensed an opportunity there. Now, we've noticed an increased number of smaller buy-to-let specialist lenders enter the market in the past 2 years. So there's been smaller lenders such as Domivest or De Nederlandse or Nesta entering the market, and they tend to be backed by warehouse funders. Now, the buy-to-let market is still unregulated, but these lenders have set up their underwriting criteria with future regulation in mind. So it is anticipated that a regulation may come along. So as such, they've tried to follow the regulated mortgage code of conduct as much as possible when setting their underwriting criteria. Now, it's a small but competitive space, and from the lenders that we've seen, they tend to have broadly similar criteria in place and rates as well. So what differentiates these companies and enables them to win business is their speed and the quality of service that they provide. Now, in order to become established, we've noticed that many of these smaller lenders start off their business by employing third-party underwriters in order to underwrite their applications with strong oversights in place. And slowly they tend to bring that underwriting process in-house. They also tend to start off using third-party services. There's an established third-party mortgage servicing market in the Netherlands, and we've noticed that the servicing tends to stay outside of those services as well, and again that they tend to have strong oversight and controls in place there. So there have been some recent changes that have potentially affected the buy-to-let market. So on the 1st of January of this year, there was a property transfer tax or stamp duty increase from 2% to 8% for non-primary residences. And that stamp duty remained at 2% for owner occupants. So in effect, buy-to-let properties have been taxed with a stamp duty levy of 8%, and that will continue into the future as well. So that chart there just shows the differences in the stamp duty from 2020 to 2021. Now, there were some other changes as well, apart from the stamp duty change that could affect the buy-to-let market. So on the 1st of May 2021, the Dutch government implemented a cap on rent increases of inflation plus 1%. Now, this cap is for private sector sitting tenants only. It applies for the next 3 years as well. And the maximum allowed increase was 2.4% this year. So far in 2021, the average rent increase is 0.3%. And when you compare that with the inflation rate last year of 1.3%, this means that the increases are well within the new rent cap. We believe that the cap could indirectly increase the turnover of tenants. So if a tenant's lease is coming to its end, then a landlord could be reluctant to renew that expiring lease in order to achieve a higher rent. If you look back at the 5-year running average for rent increase for new tenants entering a property, that increase is 7%. So if you compare that to the maximum allowed increase of 2.4% this year, you can see why there might be some reluctance from landlords to renew leases there. The cap has done little to slow the increasing cost of rental properties versus tenant incomes, as we saw on the previous slide. Now, at the end of 2020, before the stamp duty rise came in, there was a flurry of activity in the buy-to-let market, and then there was a slowdown in early 2021. But that market has picked up again and is growing at similar historical rates despite these new rent cap rules. So we think that the market is still buoyant as the reward of the long-term yields from a buy-to-let property outweighs the cost of these measures. So there's some impending changes in the market as well, which could affect things. So there's a new law which is anticipated to come in on the 1st of January 2022, and this is the Purchase Protection Scheme. Now, this scheme will allow local councils to ban investors from purchasing properties that are considered to be in the low to mid-price segment. And it is up to each council to decide what constitutes a low to mid-price property. And I'll speak about that a bit more in a second. Now, 1/3 of all houses sold in the 4 big cities, Amsterdam, Rotterdam, The Hague and Utrecht, last year were sold to investors. And at the end of October this year, the Kadaster, which is the Dutch Land Registry, said that private investors own almost 18% of the housing in the big cities. So this scheme is actually designed to allow first-time buyers a better chance to buy a property. Now, part of the scheme, it doesn't allow for any houses or properties that are purchased to be rented out in the first 4 years of ownership. There are some exceptions to that. So if a property is purchased that's already rented out, so if it has a sitting tenant, they may continue to be rented out. You are allowed to rent to a family member. And also, if the owner of the property is occupying it, but then moves overseas temporarily, for example, if they were offered a job overseas for a year, then they will temporarily be able to let their property out as well. So there was a version of this scheme implemented earlier in the year that applied to new builds only, but now this scheme is extended to all properties. Amsterdam is anticipated to be the first city to introduce the scheme. They expect to have a decision made in February 2022. Now, Amsterdam has set its definition of a low to mid-price property as anything less than €512,000. And as we heard earlier, the average purchase price of a property in the Netherlands now is €402,000. So this is well above the average purchase price. So you should prove to be an affordable property for somebody to buy. Other Dutch cities are expected to follow Amsterdam's lead in implementing this measure, and the first ones that are expected to follow are Tilburg, Utrecht, The Hague, and Rotterdam. And of these cities, Tilburg is the only one that has set its definition of a mid-price property, and they've set that at a WAS value of up to €325,000, or the maximum national mortgage guarantee amount. So, with this in mind, we think that investors may just shift their focus to either more expensive properties, so above the minimum value that's set by the local councils, or to the outside of cities. So, for people looking to rent, this scheme may lead to a shortage of affordable rental properties, particularly in cities. And that's particularly true if investors have purchased more expensive properties that are available to let. If it's a more expensive property, it's likely to have a more expensive rent. Subsequently, if there is a shortage of affordable rental properties in cities, then renters may look to move outside cities, which where more affordable rental properties are available. So that is why also we think that investors may shift their focus to outside of cities, because the rental market may just move there. So at the moment, the buy-to-let market is still showing signs of sustained growth, despite all of the recently introduced government measures of increased property transfer tax and the rent increase caps. But we believe that it remains to be seen if the new purchase protection scheme that comes into effect in January will have a significant impact in curbing the demand of the buy-to-let market. So that's a kind of an overview of where the buy-to-let market is and some of the recent changes that affect that. So the securitization of Dutch buy-to-let mortgages is started in 2017 with issuances of €0.8 billion euros, and it's continued in recent years as well. And now the total securitization of buy-to-let mortgages reflects both the growth of the private rental market and the interest of investors in the Dutch housing market. And we can see that because the overall total securitization has increased to €4.9 billion as at Q3 of this year. Several of the buy-to-let lenders that are securitizing are the ones I spoke about earlier that entered the market in the past couple of years. And if we look at the recent flurry of activity in the buy-to-let market prior to the property transfer tax changes and other changes, we expect more transactions coming to the market in the form of buy-to-let RMBS securitizations, as well as non-buy-to-let mortgages as well. So, within DBRS Morningstar, the analysis of Dutch buy-to-let residential mortgage loans is covered by our proprietary insight model that is used for credit analysis. For a typical Dutch buy-to-let pools, we would see the expected loss for the AAA rating category between 7 and 10% as per our methodology. The expected loss rate would be lower in a prime Dutch non-buy-to-let mortgage portfolio due to the nature of the product, as we see it as less risky. Further information about the insight model is available in the DBRS Morningstar European RMBS Insight methodology and European RMBS Insight Dutch addendum. So, in conclusion, DBRS Morningstar believes that the Dutch government is taking appropriate steps to resolve the housing shortage under difficult circumstances, and that construction will continue to increase to meet demand. The buy-to-let market has shown strong growth in recent years, despite the recently introduced government measures of increased property transfer tax and rent increase caps. However, it remains to be seen if the new purchase protection scheme coming into effect in January, along with other national and local government measures, will have a significant impact on cooling off the buy-to-let market. So that concludes my presentation, and if anyone has any questions, please type them in.
We see no questions yet, so we remain available if audience have any questions. All the latest research can be found on our website, which is on dbrsmorningstar.com, along with analyst contact details, should you need to get in touch with us later down after the webinar. Replay of this webinar and presentation slides will also be available on our website. And this will be the last webinar of the year from a European structured finance side from DBRS Morningstar. And we will resume our normal service of webinars on topical issues concerning European structured finance and cover bonds from January 2022. I take this opportunity to thank you, the audience, for listening, and thank you, Simon, for participating in this webinar. And to you all, greetings of the festive season coming ahead. Please stay safe. Thank you.